Okay, good evening, everyone. Thank you for joining us this Friday evening. So, most of you here are our clients, so welcome. To the others who have joined out of interest, we are really happy to host you today. So, let me briefly take you through the agenda for this session so that you know what's coming up. So, the session will start with Sunil, our director of the mutual fund distribution at Quinstinct. He would be covering briefly about our market type model and take you through the big picture of how the recovery has been like so far. Sanjay, director of the investor advisory arm, would be taking us through the earnings analysis and its implications for the broader market going forward. I will then come in to share the risk and reward as indicated by our market type model and finally recommendations for your portfolio. So before we get started, if you have any questions during the sessions, you can click on Q&A, which is visible on the bottom of your Zoom window, and type in your questions. So we would request you to hold on to your questions during the session. You can type in the chat, but you would not be able to unmute and ask. So, but after the session, we'll have 30 minutes for Q&A where you can raise your hands, ask questions, and any clarifications about the presentation, you can go ahead. So with that out of the way, I now invite Sunil to start with the session.
Thank you for joining in on our market update webinar. We don't do this on any fixed schedule. We'd like to think that we come and talk to you when we have something interesting happening in the market, and we want to share that with you. When it comes to investing, people often ask whether it is a good time. Is it a good time to put the money in? The problem with this question is that there is an underlying assumption that the so-called expert answering this question actually knows whether it is a good time. We believe that there is no expert who can consistently get it right when it comes to predicting the market movements. The second problem is that investing is always counterintuitive. You get the best investing opportunities when the economy has already taken a downturn and things are looking bleak all around. The COVID low of March 2020 is a perfect case in point. So in our opinion, the right question to ask is not whether it is a good time to invest, is to how to invest in any given market environment. At Quinstinct, we believe in asset allocation, and we try to eliminate the need for luck in long-term investing success. Let me explain how we do it. The asset allocation in your portfolio is determined based on two inputs. The first input is your risk profile. Our risk profile questionnaire helps you identify the risk tolerance and risk capacity. And the second input is our market type model. This is the market type model where we try to answer this question. Is it even possible to have a forward-looking approach? We divide the market type into six distinct market types based on the relative attractiveness for investing. In a market type 1, as you can see here, the average 1-year forward return is 56% with a high of 105%. But when it comes to a market type 6, the average return falls to minus 18%. And there is a 68% probability of negative returns. So the asset allocation decision is a combination of your risk profile and what we understand about the market from the market type model. So this is a sample risk profile graph where what we do is that based on your responses, based on your risk capacity and risk tolerance, we define an allocation range. In this case, the green band, which is 40 to 60, is a steady state allocation. Apart from defining the allocation range, what we do is that we take input from the market type model and increase your equity allocation in a market type 1, 2, 3. So basically, when market is attractive, we increase equity allocation. in a market type 4 and 5, where the average 1 year forward return is between, in a market type 5, it is 2%, and in a 4, it is 9%. So that is a time when we maintain the equity position. And only when it comes to a market type 6, when the average forward return is negative, we take a call and decrease equity allocation. So why this is very important is that this is very different from a trading in and out approach. This is only put into action in market extremes. Like we had only a couple of calls in the last decade. The first one was in Jan 2018, when we had a call to decrease equity allocation. This was followed by a significant correction, almost a 40% correction in mid caps, and a 15% correction in the Nifty index. Similarly, the second call was given in March of 2020, where at the time of COVID low, we were able to substantially increase equity exposure. We are currently in a borderline between 4 and 5. In a market type 4, the average return has been 9%, and in a 5, it is only 2%. So what we are seeing is that currently we are between 4 and 5, and that indicates a hold market type. Again, this has to be seen in the context of how earnings is coming out. And we do this quarterly earnings analysis of a subset of BSE 500 companies. Here in this graph, you can see that the last 2 quarters, in September 2024, there has been a slump in both sales growth as well as earnings growth. Whereas in the last 2 quarters, there has been a slow recovery. We will come to the earnings study in a little more detail in the second part of the presentation. The reason why market is at a market type 5 at this point of time, one of the reasons is that valuation remains high. The Nifty standalone PE currently is at about 25.75 times. We are also seeing some return of FII investing. In the previous quarters, there was a significant exit from FIIs, but there has been a slow return of the FII investment into the market. The net investment is positive for the last 3 months. USD INR has gained some ground. It has appreciated against the USD. But I think that has to be seen in the context of USD weakness across major currencies. On 1st of March, when we had the last webinar, the market was down at that time by about 15%. The Nifty was down by about 15% from the September high. And at that time, based on our experience with the market model, we said that the correction is almost done. We are not anticipating significant downside from there. And we also said that there is money to be made, in that we are expecting a full recovery by March of 2026. What has happened is that on 1st of March, we had that webinar, and on 4th March, the market actually bottomed out with a drawdown of 16% from the peak value. This I'm talking about the Nifty 50 index. And from that point, it has already recovered by about 13.7%. The interesting thing is that mid-cap and small-cap indices have recovered much faster. Mid-cap is up by about 24.8% and small-cap is up by 30.6%. When we do the detailed earnings analysis, you will get to see why that difference in the pace of recovery in mid and small-cap. Again, going back to that topic of no expert getting it right consistently, some of you might recall some people asking to completely exit out of small caps, and the subsequent recovery proved them wrong. But this is not to say that small caps are attractive. Small caps are definitely very expensive. The Nifty index is currently down by about 4% from the September high, with the result of this slump and the subsequent recovery. The mid-cap index is down by 3.6%, and the small-cap index is down by 4.5%. So this recovery is faster than we had anticipated. Interesting thing is to note that most of our portfolios are either at a break even or they are beyond the September peak, thanks to the asset allocation approach. So this is taking a slightly bigger picture. From 2020 onwards, Nifty has returned a CAGR of 14.3%. Mid and small caps have given a higher rate of return. While this is indicative of the higher risk, higher reward spectrum of mid and small cap, this is also indicating some kind of an overvaluation, especially in the small cap space. I would say the same for mid caps, except that our earnings study is showing higher profit growth for the mid caps. So with this, I'll hand it over to my co-director Sanjay to take you through the details of the earnings study and our expectations of the market.
Thank you, Sunil. So Sunil has taken us through the fall and the recovery. The question is why the fall and why the recovery? We had talked about the reasons for the fall and what triggers we were anticipating for a possible recovery in our March webinar. And to that extent, some of what I'm going to kind of cover now over the next few slides is probably what we had talked about in March. But the thing that we have to keep in mind is that a lot of things are said. And a lot of things sometimes are said with just the objective of really kind of distracting. Like the story of the walrus and the carpenter, the walrus keeps on talking about various things where the walrus and carpenter are taking a few oysters out on the seaside for a walk. And in the distraction of this talk and the patter of shoes, ships, sealing wax, cabbages, and kings, the carpenter and the walrus end up eating all the oysters. So as investors, I think our objective is to be oysters which will grow and mature to have pearls inside of them rather than getting eaten up by the noise and the distraction. So what we are going to try and do is to decode the signal from the noise and talk about what really matters when it comes to going forward from here. So let's very quickly look at why the decline happened. First, the decline happened because suddenly between June and September of 2024, we saw that there was a huge drop in profits. When we talk about profits, in our study, we're talking about a measure called profits before taxes and extraordinary items. Largely, the idea is to take off the impact of taxes and take off the impact of one-off things like forex gains and losses and something being written off because of adverse business conditions, which may not repeat in the subsequent quarters. And therefore, you should not kind of be taking those into account when you're kind of looking at what should be the normal profit growth across industries. Because we're dealing in aggregate numbers, these kind of aberrations start influencing them and causing much more undue volatility than what would otherwise be the case when we're looking at these numbers. So that is why we're looking at profits before taxes and extraordinary items, and that dropped from 13% to 6% in September. However, over the next couple of quarters, there has been a partial recovery. However, there has not been enough of a recovery to warrant the kind of move that we've seen. That, the Nifty, which had dropped to about 16% below its all-time high in September 2024, is just about 4% away from that all-time high. So does this kind of profit growth warrant that recovery? No, it doesn't. But I think what we spoke about at that point in time, which was that there is nothing fundamentally wrong with the economy. When earnings dropped from 13 to 6%, suddenly there were a lot of social media posts and there was a lot of chatter about wage growth is not happening. We busted that myth. During our webinar, we said, no, wages are actually growing and they keep pace with sales. The only problem is wages grew very, very rapidly in 21 and 22. And therefore, in 23, 24, they've normalized. It is not that wage growth is not happening. Therefore, there is nothing that is a natural barrier that the economy is hit. And because of that, growth is not happening and we've hit a peak, we're falling off a cliff. Those kind of things we disabused. What really happened and what we will again cover and show is that demand as measured by the aggregate sales of these companies, really took off post-COVID. And after a 2-year extraordinary growth kind of a situation, now we are normalizing. And we look at what the implications of that normalizing are going to be for us. As I said, this is actually the most important thing. This is the signal that we've got to look at. Forget all the noise that gets wrapped around it in terms of economy is doing well or economy is doing badly, or Donald Trump's tariffs and what impact it is going to have for us, or various geopolitical tensions all around the place. As investors, I think the most important thing we've got to do is keep an eye out for earnings. So the sales growth slowing, as we spoke about in our webinar last, is not a new phenomenon. It's an old thing. It's been happening from 2023 June onwards, and the slowdown has happened, and it's now going in a 7 to 8% range. However, when you look at it from 2016 onwards, sales growth normally over this period, over the last 9 years, has been of the order of 10% or so. The question is, are we going to go back to that 10%? Are we going to go above 10%, or are we going to remain in this range? That is the question that has to bother us as investors. And that is what is going to determine whether we're going to make new highs, or whether we're going to get stagnated at this point in time, or whether we are actually going to have another possible correction setting in. So let's just look at sales growth, right? As I said, sales growth for the overall period has been about 10%. But before COVID, we were growing at about 10.8%, which dropped to about 1.9% in the COVID time. Took off and really grew at 22% for the next couple of years, and then has started normalizing at about 7% today. So when you look at the overall period, the overall growth is about 10.2%. So we should not take this, which is that 7 to 8% range that we're talking about. I hope once I get my pointer up, this is not the new normal for us. This is the old normal, and it continues to be the old normal. That is what we've got to be focused on as investors. So when you put this together, basically what we're saying is that if you're going to revert to this normal of 10.2% by March, and there is no reason why we should not, because the economy does not have structural problems dragging demand. And this problem has been purely cyclical only because we grew at a very, very high rate, and then we started normalizing. So we are saying, yes, we can go back, but beyond this blind faith in reversion to mean, saying that we grew above mean, then we went below mean, now we are going to be at mean. What are the factors that will aid this recovery? First, we have had a decline in the USD INR. As Sunil explained in the dashboard slide, we have appreciated vis-a-vis the USD in the last couple of months, but that has to be seen more in the context of dollar weakness rather than rupee strength. So we are still competitive. Against the euro or the pound sterling, we've hardly moved. Liquidity measures and interest rate cuts. So when we started the webinar, or rather at the beginning of the year, we were at about 6.5% on the benchmark repo rate, which the RBI uses to gauge the level of price of money in the economy. And in the last 5 months, they've actually brought that rate down to 5.5%. There's been a full percentage point cut. And indications are that there are likely to be at least 1 or 2 more cuts. Maybe the repo is going to come to around 5% by the end of the year. So tax relief, which happened in the budget of 2024 July, and this is going to be the first full year. And more importantly, this is going to be the first year when people are filing taxes and who are going to see what kind of surpluses they're going to have available at their hands for consumption or saving, as the case may be. So all of these, we believe, will aid the recovery. And finally, most important, prices are not going out of control. The consumer price index indicates that there is fairly benign inflation. And the fact that the WPI, the wholesale price index, which can be seen as an indicator of producer costs in the economy, is still remaining flat, which means that there is a possible scenario where margins can expand because input costs can continue going down for companies. So all of these put together are looking fairly positive for the economy. So this is a calculation we've done. I'm not sharing the details of these calculations. I can always share that with any of you who are interested in getting into the nitty-gritties of this. But largely, if the sales is going to grow at par, which is 10% or so, and the profit margin expands, we are going to have a growth of 14% in profits. If the profit margin is the same, it will grow at about the same rate as sales, which is 10%. If the profit margin contracts, which we believe is unlikely at this point in time, then the growth halves from 14 to 7%. So broadly, when we're looking at it, profits can grow anywhere between 4 to 15%. But we believe this band, 10 to 14%, is the most likely scenario for profit growth in FY 2026 for our sample companies. So we looked at our sample companies. Most of you look at this benchmark called the Nifty, right? So I thought I would just give you a quick snapshot on what Nifty looks like. So this is data that we've taken from our database provider, Ace Equity. So when you look at Nifty, this is the breakdown of sectors, that there are a few sectors which have done above normal growth 2025 over 2024. And there are a few sectors which have gone below normal. And some of these sectors which have gone below normal actually in 2024 were the outperformers. So in some sense, the cycle has actually reversed for many of these sectors. However, when you look at it, the percentage of companies who are doing 10% or more of profit growth is about 48%. Almost half the sample is growing at about 10%. It is being dragged by the other half, which basically means that if our mutual fund managers start to get, and they have to a large extent managed that over the last year, get their stock selection right, you're going to be invested in portfolios where the profit growth is probably above the benchmark. So the Nifty 50 itself, the earnings grew at 5.4%. Our sample, when we saw, the consolidated growth was at 6.8%. And that is largely because, as Sunil also pointed out, the BSE 500 has mid-cap companies also, and mid-caps have actually outperformed the large caps in terms of profit growth over the last few quarters. What are the possible drags? Why am I not saying that we are going to get into a runaway bull rally at this point in time? Largely because valuations are still elevated. As Sunil shared, we are still at about 25.75 times on the standalone PE, while we are nowhere close to the 40 times. That 40 times in 2021 was an aberration. And I think anytime we are above 23, 24 times, we have to start being somewhat cautious about market prospects. There are going to be significant short-term reactions to noise, and that, however much we may want to ignore, sometimes we will not be able to ignore. So to that extent also, we have to be a little cautious and not go all in on equity. FII flows are always a bit volatile. We don't know how they're going to go. That also depends on new noises the Trump administration is going to make, which in turn will also kind of influence or will be influenced by currency movements. So all of these are tied in together. The short-term volatilities are still going to be significant, and we will have to really wait and see through these volatilities if we want those long-term gains. Okay, with this, I'm going to stop, and I'll invite Malar to take over and talk about the risk-reward scenario and what we are prescribing at this point in time. Thank you.
Yeah, thank you, Sanjay. So far, Sanjay presented about earnings. So now we're going to look at the market type model and see what it has to say about the risk and reward that has in store for us. So this is a table which shows by how much the market can fall when it starts from each of these 6 market types. So for us, the relevant ones are market type 4 and 5, because that's where we find ourselves right now. It's right in between 4 and 5. So when we are here, there is a 40 to 50% chance that the market if it falls, would at most fall by 10%. The higher probability sits here. However, if the markets progress to a 6, and if a fall happens then there's a 50% chance that it's going to be more than 30%. So the risk type of our market type model suggests caution because we are in between 4 and 5 with 6 not too far away. And let's look at the reward side of the market type model. So as Sunil presented earlier, the average return when you're in a market type 4 is 9%, average 1-year forward return, and that for market type 5 is 2%. So not too attractive, and when it moves to a 6, you have a very high chance of negative return. So both the market type, the risk side and the reward side of the model suggest caution. And with that context, I'm going to talk about answering the question that we want to be asked, how to invest in the current market situation. So I'll go asset by asset, first starting with equity. So equity, as we saw, it's the majority of the recovery is done. And for those who invested in February have seen very good returns so far. However, the balance now is tilting more towards risk than reward. So our suggestion is to hold equity allocations that you have right now. Unless you're severely underallocated, do not add significantly to equity. And as it moves to, if it moves to a market type 6, we need to be ready to reduce risk as well. By reducing risk, I mean reduce allocation to equity in your portfolio and add to debt. So the next asset class is debt. So far, debt returns have been really good. However, the rate reduction cycle is behind us. So beyond this, we do not see that rate is going to reduce. So we no longer recommend allocations into dynamic bond funds, especially those with very high durations. So our focus is going to be on medium-term AAA oriented funds. So as usual, we are going to be negative on credit plays, like whenever, even before and now, and that's going to continue. But debt continues to be a safe asset, which is low risk and which gives us FD or more returns with better taxation. And last is gold. Gold is at a all-time high right now in USD. However, its prices, though unpredictable, are not correlated with equity. So hence, we recommend a 5% allocation in the portfolio at most. And when building it, to do it in a staggered manner without short-term expectations. So because gold goes through these long cycles of price where you do not know where you're getting caught. So short-term expectations without it will be better, and a 5% position is okay. So with that, I come to the end of the presentation, and I'd like to just summarize what we've seen in the past 30 minutes. The first is that about the recovery of the Nifty 50 and the other indices, from Nifty 50 recovering 13.7% to small caps recovering 30% from the lows of February. Our earnings studies show the base effect continuing to wear off, and PBT growth, the range of that is attractive between 10 to 14% for next year. Our indicators from the market type model show that by March 2026 the recovery will be complete back to the September levels. However, given valuations the way they are, if the market moves to a type 6, we need to be ready to reduce allocations. So watch out for, if market type moves to a 6, valuations remain high, and other short-term FI volatility and other terms. So in summary, your investment strategy, the main strategy of having an asset allocated portfolio does not change. We always need asset allocation. You need both a risky one like equity, which is going to give you returns, and debt, which is the low risk asset. So our recommendation is equities, no significant additions, maintain allocation. Debt, reduce or wind down portfolios with longer term maturities and stick to AAA medium term bonds. And gold, a 5% allocation built in a staggered manner will be okay, because since its prices are unpredictable, However, it's not correlated, so it can be there in the portfolio.
See, we do not like to take absolutist calls when it comes to market expectations. So, on the debt side, while most of the rate cut cycle is over, there could be further rate cuts also. So yields have come down because of rate cuts, but we are not ruling out the possibility of further rate cuts. Thank you.
Right. So yes, questions, you can either type your questions in the chat or you can raise your hand and unmute and ask your questions. Yes, Mr. Kalyan.
Yes, thank you for the presentation. I need to go through one by one because immediately I'm in different field to understand all these things. Difficult for me to take it up. One thing I just want to make sure, if I have a risk profile of 50% plus, as I indicated earlier, I think I can continue in the same manner. Correct?
Yes. Yes,
No,
you can
no
continue.
need to change or anything
Correct.
to shift.
Correct. Correct.
Okay.
Kalyan,
Okay.
we are talking about holding whatever we have already done at this point in time. If we are going to do fresh investments, we want to be cautious about taking equity exposure in those fresh investments. And our current investments, we will reduce equity allocations only if we get to a market type 6.
But if you want to invest, we can go into debt.
Yes, you can go into debt at this point in time. Whatever we would normally invest for equity, we could either invest into debt or we could park it in arbitrage funds and wait and see if there is a correction in equity markets. If that happens, then we can use that fund that is parked in arbitrage funds to move into equities.
Okay. Okay. And would you mind to share this presentation?
Yes, we'll share the recording with you, Kalyan.
Okay. Thank you.
Yeah.
Thank you.
Yes, Mr. Amit.
Yeah, you could hear me? No.
Yes.
Yes, we can hear you.
So nice presentation. Definitely, we normally discuss that way only. Many times I have discussed with you people. One thing I was thinking, since the inflation is benign and rate cuts are expected, so some of the debt funds, the mark to market is going to increase. Now, it may be, and at the same time, if rate cuts are expected and makes money easily available for the corporate, there is a chance of their profit increasing.
Correct.
In the market type 6 threshold is going to shift further. We may be, because if the companies increase their profit, then the market type 6 threshold also keeps on moving. But
absolutely,
debts have become also attractive on the mark to market basis that my NAV is going up. Where do I go?
Yeah. Excellent question, sir. Very, very glad you asked this. With your permission, rest of you guys, I'd like to at least do the first part of the answer, and then you can chime in with whatever you believe I've left out. So yes, I think exactly as it was pointed out, what is going to happen is that this market type 6, we kind of keep measuring this on a weekly basis and saying at what index level do we think you're going to get into a market type 6. Sometimes that drops. Sometimes week on week. Sometimes that gets pushed back week on week. And it depends on all these things. It depends on profit growth because every quarter companies are coming out and declaring their profit numbers. So as those profit goalposts shift, the market type the level of the index at which a market type changes from one to another will also shift. Interest rates, because that will determine the liquidity that is available in the market, that will also be a key determinant. And the valuation relative to the interest rates will be the most important thing that we will also have to look at. So you're right. In fact, we anticipate that over the next 6 months, there will possibly, if you're measuring, for example, today saying that, let's say 28,000 is going to be a market type 6 for us on the Nifty. it is possible that over the next 6 months that will shift to about 30 or 31 or 32 also. And we'll keep monitoring that. So it's not that we are going to be very blind and saying the moment we hit 28, we are going to kind of reduce allocations. We will look at all these factors.
There is no knee-jerk reaction on this. You got to study the market, and
we will look at all these factors. We will look at all these factors. So absolutely, I think that was a brilliant insight. So thank you very much for that. The other thing that I also should address is what about the mark-to-market component on rate cuts? So what we saw was that in anticipation of the RBI on June 2nd had reduced the repo rate from 6% to 5.5%. That was about a 0.5 percentage point decrease. But if you look at the 10-year bond, it hardly moved 10 basis points. It moved down from about 6.4 to from 6.35 to about 6.25, and it's now at around 6.3 levels. So I think mostly there are two things: the cuts by the RBI and the expectation of the cuts, which is built into bond prices and bond yields in the secondary market. So while there may be 1 or 2 more rate cuts that may come from the RBI, we believe that a majority of that action is already built into bond prices at this point in time. So we may not see too much of a mark-to-market gain, which is why we are saying probably some of the investments we made in 2023 and 2024 into long-term or dynamic bond funds, anticipating these rate cuts, some of them we can reverse. As Sunil said, we should not be absolutist. We should not come out of everything. But where we can sensibly reduce those exposures, we can reduce it, because all said and done, the short end of the curve is also going to play on the mark-to-market gains. It may not give you as much as the long-term funds, but it will still participate. It will still give you some gains. Right. Anything to add? Anybody else?
Yes.
The technical side you covered brilliantly, Sanjay. I would mention the behavioral side. So typically in a market type 5, people start asking the question, this fund is giving me only 15%, whereas the other one is giving me 30%. Why don't we shift from the 15% fund to the 30% fund? So when that happens, I intuitively know that it is a market type 5. And in a market type 6, people ask, why have debt funds at all? Why don't we move everything to equity? That is the time to take money out.
Take money out. Exactly. Right.
So yeah, we'll continue monitoring these questions also, along with the fundamental and numerical factors that we look at in the market type classification. But thank you so much for that question. I think that was really a very, very insightful prediction of what might happen.
Yeah.
Anything else, Mallar? Any other questions?
Any other questions? Don't worry if the question is too obvious. Anything at all you can ask.
One more question.
Kalyan. Sure.
Why don't we provide a kind of update on each fund? How is it performing? Will it be possible?
Yeah, so you do get that update as part of your regular monthly report, right? And also you have a sign into your web portal where you can see it not just on a monthly basis, but on a daily basis.
Okay.
So that update is available. But again, as Sunil said, what we would like you to focus on, rather than look at which fund has performed and which hasn't, because that keeps changing.
Yeah.
The fund that performs today will not perform tomorrow. And our idea is not to kind of get you into a fund which will be the absolute top performer over the next year or next 6 months, because nobody can do that for you. What we are looking at is to get you into funds which are the most reliable across cycles, both on the equity and debt side. And we have different criteria for equity and debt funds to achieve that reliability. So the thing that you actually have to look for is not really fund-wise what is happening, but what is happening to your overall allocation. Are you allocated properly to equities? So for example, in your reports, you will see that this is your current allocation, this is your risk profile. When you look at it, I think what you need to look at is, are you allocated according to your risk profile? Are you over-allocated? Are you under-allocated? And if you're over or under-allocated, you should ask us for an explanation.
I understand. Yeah.
between three of you, you have given a fantastic presentation. Most of the questions,
Thank you.
when it was just getting charmed, by that time you have already covered. So how do we question more?
Thank you. Thank you so much.
So nicely covered, I must say.
Fantastic. Thank you. Thank you. Thank you. Thank you for
very
taking
much.
time out on a Friday evening to join us. Pleasure hosting you, and we'll look forward to connecting with you again maybe in some time. As Sunil said, we would probably like to do this when we have something significant to share. Right now, our takeaway this time is to say that last time we said equities are attractive buy. This time we are saying that situation has changed. You don't need to panic and exit, but you don't need to be buying aggressively either. So as the situation changes, we will keep you updated and we will come to you with fresh updates. Obviously, if anybody has any other questions, you can please feel free to reach out to us through the regular channels, phone, WhatsApp, email, whatever you would like. We'll also make the recording of this available to you. So at any point in time while you're going through that, you have any questions, please feel free to ask.
So yeah, I think thank you everyone, and see you in our next webinar.